Why has the housing market ground to a halt? Not rates alone, but the plumbing of power. $1 trillion money printing for deficits left homeowners glued to cheap loans, dooming millennials to eternal renting. The housing freeze is not a natural market correction, but the predictable outcome of a fiscal monetary regime that prioritized deficit financing over real economic credit, locking wealth into assets for the few while starving access for the many. This is not about supply and demand in any textbook sense. This is about institutional power, about who gets cheap credit and who pays the price when that credit dries up. And right now, an entire generation is paying. Let's start with the numbers, because they are staggering. Existing home sales in the United States have collapsed to their lowest levels in a quarter century. 25 years. Not since the turn of the millennium have so few homes changed hands. And here is the paradox. Active inventory has risen over 12% year on year, reaching roughly 990,000 homes. More homes are sitting on the market, yet new listings have actually fallen. Homes are not selling, they are simply languishing. Buyers have vanished, sellers refuse to list. The market has not cooled, it has frozen solid. Why? Because moving house today means financial suicide for anyone who locked in a mortgage rate around 3% during the pandemic years. To sell and buy again is to swap that cheap debt for a mortgage at 7 or 8%. It means doubling your monthly payment for the same house, or accepting a far smaller, worse home for the same cost. Economically, it makes no sense. So people stay put. They cannot move for a new job. They cannot downsize when the kids leave. They are prisoners of their own equity. And let's be clear about what that equity represents. It is not a reward for hard work or prudent saving. It is the windfall from a central bank policy that flooded the economy with money, bidding up asset prices while wages stagnated. Homeowners who bought before 2022 captured a once-in-a-lifetime wealth transfer. Those who did not are now locked out, possibly forever. This is not a housing market. It is a sorting mechanism separating the asset-rich from the asset-poor, the old from the young, the protected from the exposed. How did we get here? The story begins in 2020, when the Federal Reserve, in response to the pandemic, unleashed the most aggressive monetary expansion in modern history. Interest rates were slashed to near zero. Quantitative easing, central bank purchases of government and mortgage-backed securities, ran into the trillions. The official narrative was pandemic relief, support for workers and families. The reality was deficit financing. The federal government borrowed and spent on an unprecedented scale, and the Fed monetized that debt, holding down interest rates to make it affordable. Treasury bonds and mortgage-backed securities were bought in vast quantities, cheapening the cost of borrowing for the government and for home buyers alike. What happened? A frenzy. Demand for housing exploded. With mortgage rates below 3%, buyers could afford to bid more. Prices soared. Homes that sold for $300,000 in 2019 went for $450,000 by 2022. Builders could not keep up. Materials and labor costs were already rising due to supply chain chaos and inflation in commodities. But the price surge was not about scarcity of homes. It was about abundance of credit. The Fed had turned on the money tap, and housing was where it pooled. Then came the reckoning. By 2022, inflation had hit 40-year highs. The Fed, having insisted for months that inflation was transitory, executed the fastest interest rate hikes in 4 decades. Rates went from near zero to over 5% in barely a year. Mortgage rates, which track long-term treasury yields and add a risk premium, shot up to 7, then 8%. The cost of borrowing doubled. Demand collapsed overnight. But here is the crucial asymmetry. Sellers did not flood the market. They stayed put. Why would you sell a home with a 3% mortgage to buy another at 8%? You would not, unless forced by divorce, death, or job loss. So inventory, which should have surged as prices softened, barely budged. New listings actually fell. The homes sitting on the market longer are the ones that were already listed, sellers testing the waters, hoping for a miracle buyer. But the buyers are gone, or waiting, or priced out entirely. And what about builders? Surely they could step in, flood the market with new supply, bring prices down. Except they cannot. Construction costs have risen by 1/3 in under 5 years. Lumber, steel, copper, all up. Labor is scarce and expensive. And now, financing a new development at 8% interest rates makes the math impossible. Builders cannot lower prices without taking losses. So they build less, or not at all. The supply response that economics textbooks promise never materializes, because the textbooks assume stable money and functioning credit markets. We have neither. On the demand side, the picture is just as bleak. Unemployment has climbed to its highest level in over 4 years. Workers who might have stretched to buy a home now fear for their jobs. And here is the kicker. Rents have been falling for 28 consecutive months. 28 months. Renting has become cheaper, more flexible, less risky than buying. First-time buyers, the lifeblood of any housing market, are staying renters. Why take on a 30-year death sentence at 8% when you can rent for less and wait for prices to fall further? Even the luxury market, insulated from the concerns of ordinary buyers, is frozen. Mansions are sitting unsold. Sellers are offering try before you buy sleepovers. Yes, you can spend the night in a multi-million-dollar home to see if you like it. It would be funny if it were not so revealing. Even the wealthy are balking at these prices. Some jurisdictions have introduced mansion taxes, 2% surcharges on sales over $2 million, a political signal that asset hoarding will no longer be tolerated. But taxes on transactions in a frozen market are taxes on nothing. The real problem is not that the rich are buying too much. It is that no one is buying at all. This freeze has historical echoes. In the 1970s, fiscal deficits and monetary accommodation created inflation. Central banks then hiked rates to break the inflation spiral, and credit markets froze. Housing, auto loans, business investment, all ground to a halt. The difference today is scale. The asset bubble, inflated by post-2020 monetary policy, dwarfs anything seen in the 70s. And the global role of the dollar means the Fed's policy whiplash reverberates worldwide. The lock-in effect we see in housing is mirrored in corporate debt, in government bonds, in the entire architecture of financialized capitalism. Cheap credit created a world of locked-in positions. Expensive credit has frozen it solid. But let's talk about power, because this is not a story of neutral market forces. It is a story of institutional design. The Federal Reserve does not serve homebuyers. It serves the Treasury. Its primary function, whatever the official dual mandate of price stability and full employment, is to ensure that the federal government can borrow at sustainable rates. When deficits explode, the Fed must either monetize the debt, print money to buy bonds, or allow interest rates to rise to attract private buyers. In 2020 and 2021, it chose monetization. By 2022, inflation forced it to reverse course. Rates rose, but not because the Fed suddenly cared about housing affordability. Rates rose because bond markets demanded it, because inflation threatened the real value of Treasury debt, because the institutional architecture of deficit finance required it. And who benefits from high rates? Bondholders, savers with capital to deploy, financial institutions that earn the spread. The federal government itself benefits in a perverse way. High rates crush demand, slow the economy, and reduce inflation, allowing the Fed to claim victory while the underlying fiscal profligacy continues unchecked. The housing market is collateral damage. Homeowners locked into cheap mortgages are winners, but accidental ones, hostages to their own good fortune. Everyone else, renters, first-time buyers, young workers, builders, loses. Now, the chorus of voices calling for rate cuts grows louder. Cut rates, they say, and the market will thaw. Mortgages will become affordable again. Buyers will return. Builders will build. It is a seductive argument, and it is wrong. Cutting rates without addressing the root cause, massive federal borrowing that crowds out private credit, will simply restart the cycle. Cheap money will flood back into housing, prices will surge again, inflation will return, and in 2 or 3 years, we will be back where we started, except the asset bubble will be even larger and the lock-in even more severe. The only sustainable solution is fiscal restraint. Reduce federal deficits. Stop borrowing trillions to finance current consumption. Where the government borrows less, it competes less for credit. Treasury yields fall organically. Mortgage rates follow. Builders can finance projects. Buyers can afford homes. The market unfreezes, not because the Fed has performed some monetary magic trick, but because the demand for credit has been rebalanced toward the real economy and away from deficit financing. This is elementary economics, yet it is treated as politically impossible. And so we come to the distributional heart of the matter. Who pays for this freeze? The young, millennials and Gen Z, who came of age during the financial crisis, who carried student debt through the pandemic, who now face a housing market that has locked them out entirely. They rent, not by choice, but by necessity. They cannot build equity. They cannot move for better jobs without the flexibility that home ownership once provided. Meanwhile, older homeowners sit on windfalls, equity gains in the hundreds of thousands of dollars, earned not through labor, but through the accident of timing and the largesse of central bank policy. This is not meritocracy. It is a rentier economy, where wealth accrues to those who own assets, and everyone else pays rent, literally and figuratively, in perpetuity. The macroeconomic consequences are severe. Housing is a massive component of GDP. Residential investment, real estate services, construction employment, all are in decline. The freeze is a drag on growth. And housing costs, despite falling rents, remain elevated in purchase prices, keeping core inflation sticky. The Fed claims victory over inflation, But housing tells a different story. The market is undergoing what analysts politely call an affordability reset. What that means in plain language is that prices are too high, incomes too low, and credit too expensive. The reset will take years, and it will subtract from growth every quarter. What should we watch in 2026? First, the federal deficit. If it continues to widen, rates will stay high or rise further, and the freeze will deepen. Second, Treasury auctions. Are bond buyers demanding higher yields? That will signal that the market has lost patience with fiscal profligacy. Third, mortgage rate spreads. The gap between Treasury yields and mortgage rates has widened, reflecting risk premiums and market dysfunction. If that spread does not narrow, even falling Treasury yields will not help homebuyers. Fourth, new listings. They are the canary in the coal mine. If they keep falling, it means sellers have given up hope of moving. Fifth, the share of first-time buyers. It has collapsed. If it does not recover, the market will remain frozen, because first-time buyers are the base of the pyramid. Without them, no one can trade up, and the whole chain breaks. And finally, watch the political rhetoric. Housing affordability is becoming a flashpoint. Mansion taxes, rent controls, calls for rate cuts, demands for fiscal discipline. These are not technical debates. They are battles over who gets to live where, who gets to build wealth, who gets to shape the future. The freeze has made the stakes visible. It has exposed the lie that housing is a market like any other, governed by supply and demand. Housing is a political economy, shaped by central bank policy, fiscal priorities, and the distribution of power. A society that locks the young out of home ownership to preserve asset values for the already wealthy is not a market economy. It is a rentier oligarchy. The housing freeze is not a technical glitch, a temporary imbalance to be smoothed out by clever policy. It is a policy choice. It is the choice to prioritize deficit financing over real investment, bondholders over builders, asset inflation over wage growth. It is the choice to let an entire generation pay rent forever so that another generation can retire on home equity. Demand fiscal honesty. Reject the monetary gimmicks, the calls for rate cuts that will only restart the bubble. Insist that credit serve the real economy, homes, factories, infrastructure, not the financing of government consumption. Insist that the Fed's mandate be subordinated to the public good, not the convenience of Treasury debt management. When will we admit that the housing freeze is not a technical glitch, but a policy choice? And who will we hold accountable?